What point would you want to syndicate versus try to JV?
I think there's a certain, somewhere between 2 million and 4 million, depending on how much capital you have and depending how much capital your partners have. If you're looking at a deal for $4 million and you need 25%, that's $1 million you need to bring to the table. I mean, that's a big chunk of change for one property for one investor.
So for $4 million, and you're able to bring in and you're able to get a 75% LTV loan, so you need 25% down. If you had four partners who brought in 250 each, that is doable. Welcome to the Ironclad Underwriting Podcast, where precision meets performance in commercial real estate. I'm your host, Jason Williams, and every week we deep dive into the strategies and systems and stories behind rock solid underwriting. Whether you're a seasoned analyst, an up and coming investor, or a commercial real estate professional looking to sharpen your edge, this show is your front row seat to expert insights, emerging trends, and real world underwriting tactics that stand the test of time and scrutiny. From market assumptions to debt structuring, cap rates to cash flow, we're cutting through the noise and getting to the numbers that matter. So sharpen your pencils and fire up those models. Let's get to work. This is Ironclad Underwriting. Hey everybody, welcome to this episode of the Ironclad Underwriting Podcast. I'm your host, Jason Williams, and I got my good friend, co-host, Frank Patalano. How are you doing, Frank?
Good, sir. Just another day trying to make money.
Um, so a lot of times people come to me and they come with like a 20, maybe a 40 unit property. And at first glance, I was like, shudder. Because that's like, it's weird, but at that size for me, it's too small. It doesn't make sense for me. And then sometimes if they come to me with like a 600 unit property, I'm like, okay, we're going to need to bring on some partners because that's too big for me. So like right now, there's like a good happy medium for me. But in this episode, I wanted to dive into small versus large deals. What do you think?
Yeah, I mean, there's benefits to both. On average, I mean, I have small stuff, I have medium-sized stuff, and I have large stuff, and there's definitely benefits to all of them. This In the past year, we bought a 12 unit out in Omaha, Nebraska. It was a 1031 exchange. We were growing our portfolio a little bit. We ended up taking on some partners, so we didn't take on any more debt. So it worked out.
Yeah.
But there's
So
definitely reasons why, and reasons why not.
so there are reasons to on some of the smaller deals, like a 12 unit, to say a or even maybe even a 40 unit, depending on the cost. It's like a lot of people come to me and they want to syndicate like a 20 unit or a 40 unit. And sometimes that just doesn't make sense. For a JV, I could JV into a 20 unit. I have JV'd into a 20 unit, but for syndication, no. And
Oh yeah, if you're
then,
if you're talking about syndications, that's a little different. I'm just talking about investing in general. With syndications, you and I both know that the attorney fees alone are going to cost you $20,000. So
then
if you buy,
that's regardless of the size. That's
yeah,
like almost a flat cost, $25,000.
so as a price per door, you're talking $1,000 a door on a 20 unit. You probably don't want to syndicate. I mean, I have syndicated. We syndicated a 38 unit. So
Yeah. Um, and if you ask Grant Cardone, he'll say, don't go for the 16 unit, go for the 160 unit or go for the 1600 unit.
well, if you ask him, he'd also say don't invest at all except invest with him.
Well, he does teach, or he used to teach people on how to buy apartments.
There you go.
So I think this topic today, let's dive into one like the investing structure. Is it you buying it yourself, or you JVing or syndicating versus well, but that, and then also I want to dig into like economies of scale, because a 40 unit and a 60 unit are going to behave differently, even though those are like 2 unit 20 unit difference. And a 60 unit and 150 unit are definitely going to behave differently. So let's dive in.
Sounds good.
There is a big misconception. Big More units equals more profit. Um, that may or may not be the case. It's not, you can't use a blanket statement. But the more units you have, generally, the more partners you have. So the smaller piece of the pie you're going to get personally.
And even if it's non-recourse, the more risk.
Yep.
Yeah. If you make a
Yeah.
mistake with a 100 unit, it's not as painful as if you make a mistake with a 300 unit.
And what we haven't even talked about, like going in, it's like, all right, we have to come up with the earnest money, 1% of the deal. So for what, a 300 unit at say,
40
let's
million,
say, okay, 40 million. 1% of that, you're looking at
400,000.
400,000. Not everyone has $400,000 laying around. Um,
If no one on the team has $400,000 laying around, you should not be looking at that size deal. Don't forget either.
yeah. Um, if you are looking at that size deal, you are going to be looking at a partner who does have that, whether it's like an earnest money lender or someone who's going to be on the GP team who just has the liquidity you need. And for whatever reason, if that deal goes south and that earnest money is lost, that person's not going to be too happy. And more than likely, if you sign like you're a loan or something, you're liable for that 400,000. And if you raise money from investors to put the earnest money down, but you didn't close, guess what? You're liable to pay all those investors back because the investment doesn't begin until you actually close. So the bigger the deal, the more risk.
Yep.
But there are benefits to having a bigger deal versus a smaller deal. So, and I mentioned the economies of scale. The bigger your deal, the cheaper your maintenance is going to be per unit. Cheaper your landscaping is generally. Pool services, trash, pest control. Because vendors like larger properties. They like um, bigger contracts. Yeah, it's a bigger contract for them, but per unit it's smaller than like a 20 unit. And actually, we have a vendor who we have like 5 acres on one of our units on one of our properties. That contract to mow that 5 acres is cheaper than the one that's like 1.5 acres or whatever.
Oh, that's something.
So
Somebody got a good deal there.
yeah, but that's just another thing. But yeah, vendors generally like larger properties. So pest
Well, it evens out
control.
their cash flow. And if the
Yeah,
property is big enough, they might be able to hire a full-time person just for that, or at least a part-time person.
yeah. Also, the bigger the property, the better it can handle vacancy. So you have a 300 unit property versus a 100 unit property, and 10 units are vacant. Then on your 100 unit property, you're sitting at 90%. On the 300, you're sitting at what,
97, 96.
97, 96%, which is a little bit easier to handle. Um, if you're looking to refi or be stabilized for bank purposes, lending purposes, it's easier for the larger property to handle that. Larger properties can generally get better rates on like roofing. Because if you got say 10 buildings on your 100 unit versus 30 buildings on your 300 unit, you can negotiate better rates for your roofing to do 30 buildings versus the 10. Same with flooring, paint, AC, appliances. Buying things in bulk is a whole lot cheaper than buying one-off type things when needed. So, but one thing that I hate about having like a sub 100 unit property is the payroll. Just sucks. Payroll is, you have to pay the person to be in that office regardless of how many units are there. So for a 60 unit to 150 unit, you're looking at basically one full-time leasing manager or property manager. And then you might have one or two maintenance guys depending on the vintage and stuff like that. It's the same for both the 60 and say the 150. But
Yeah, we've definitely had some struggles with that. We bought a 50 unit and we started with a full-time staff, and obviously it was pretty expensive. And then we switched to somebody else that was able to had other units in the area, and we had office, so he was able to use ours as an office space. And then eventually we went with another property management company, and they ended up having a part-time person there. And the problem with that is the full-time office was on another property that we were basically competing with down the street. So that was a problem. Yeah. If you're at if you're at 50 units, even if you're at 70 units, that's a bigger problem than if you're at 100 units. 100 units to 120 units is pretty much a sweet spot for a full-time person in the office.
yeah. Um and I would say for anything less than 60, you don't even really want a an on-site person. I'd rather go with a third party manager who has an office somewhere else and they just manage it and they send the maintenance over as needed. They take care of the leases from their own office, and like you said had set up. I mean, yeah, they could maybe rent your office space. That's how I would have done it, and they could run their operations, whatever. But when you do it that way, you're looking instead of like a 3% management fee, you're looking at probably a 10% management fee, 7 to 10%. But you're not paying like the actual payroll. You're not paying all the marketing and all the expenses that come with management per se. You're paying it in a lump sum to the
Yeah, so when
manager.
you say 3%, 3% plus payroll, so that's a lot. And I'm
Yeah,
not saying it's better or worse than 10%, but yeah, so we've negotiated some deals in certain areas where we're paying like 8% or 7.5%. There's no on-site. It's smaller buildings, but we have a portfolio of them.
yeah. And the more units you have, the better economies of scale you get with management too. So
Yep.
if you have 100 unit, and even if it's on site, you might be paying 4.5% versus a 300 unit, you might be paying 3% or 2.5%. So
But with 400 units, you might also have 8 employees.
yeah.
Um, yeah, so what are some examples of economies of scale?
Well, that's what I was saying. The vendors like larger properties. Um, one thing about our properties is pretty much all of our units are like identical inside. They have the same flooring, the same amenities, so that when we're buying stuff, we're buying like flooring. We're just buying pallets and pallets of flooring, and then we can lay it ourselves. When you can buy pallets and pallets like that, you get good economies of scale. If you have like some, and this goes into like maybe how to rehab units, which could be a different topic. You have like carpet on one floor and LVP on the bottom floor, and you're having to buy two of every type thing. You don't get the same economies as if you're just buying twice as much LVP for everything.
Yeah,
Um,
we got a recent great deal on some roofing supplies on our 38. We have a 38 unit, and we were able to get a great price for all the roofs.
yeah.
You know.
Um, Another thing is lenders like bigger properties. Especially in my market, they hate anything less than like a $5 million loan. Actually, they prefer like 10 to 15 plus $1 million loan. Freddie and Fannie, they like 10, 15 plus $1 million loans. Anything less than that, they consider it a small balance loan.
That probably has to do with the same way that we're talking about a 40 unit versus a 100 unit. The paperwork for the bigger loan, for the higher priced loan, is probably pretty much the same as paperwork for the smaller.
Yeah. Yeah, I imagine it is. And it's easier to spread it out for a bigger price than the smaller one.
Yep.
Um, Now, when you do your due diligence, you still want to walk every single unit, and
Absolutely.
for a 300 unit property versus a 100, you're going to have a bigger team to go do it, or you're going to have to spend more time doing it. So,
Usually
but
on a property that size, you hire out
yeah,
the walkthrough service.
even for a 100 unit, you're gonna I would hire out, but make sure that there's enough people to go through them all so that you can get through everybody in like a day, maybe two tops. So, because you don't want to put the residents out more than they need to.
Yeah.
And insurance, they like bigger properties also. Again, it's the same amount of paperwork for a 300 unit as a 100 unit. Now, if you're looking at, say, three 100 units versus one 300 unit, it pretty much acts the same. You get the portfolio pricing basically. So, yes, 300 units versus three 100 units is almost the same as the 300 on economies of scale. It also depends on how close they are to each other.
As I
So,
said, as long as they're in the same market.
yeah. Let's see. Hidden diseconomies of scale. So, where does it actually suck to be a larger property? More employees typically mean more employee turnover. Also, with more employees, you have to approach the management differently, because instead of just like dealing with a regional who's over like one or two people on your property, you're dealing with a regional who might be over six or eight people on your property, including the office staff and maintenance staff. So then, and there might be a hierarchy between those 6 to 8 people as well that you have to work around as well. Um, Software, I think it's typically like a per unit thing, so it'd be similar regardless, just a bigger paycheck. So I think for the most part, the economies of scale outweigh the disadvantages. But now let's get into like the the formatting, the structure of the partnership. What point would you want to syndicate versus try to JV?
I think there's a certain, somewhere between 2 million and 4 million, depending on how much capital you have and depending how much capital your partners have. Uh, if you're looking at a deal for $4 million and you need 25%, that's $1 million you need to bring to the table. I mean, that's a big chunk of change for one property for one investor.
Yeah.
So
So for $4 million, and you're able to bring in and you're able to get a 75% LTV loan, so you need 25% down. If you had four partners who brought in 250 each, that is doable. If you are needing to raise $1 million via syndication, that is like a super gray area. It's like I would say between like two and four. I was like, I wouldn't even try to syndicate. I'd want to go larger than four. Um, the larger the better for syndication. Um, but yeah, I think I would just try to partner with someone who has the capital looking to invest and stuff like
you
that.
say the larger the
That don't.
better, but sometimes to start out too big is too big. When you have to raise $17 million on a deal, especially in this current environment, it's a little tough, you know?
Yeah, and I agree, and that goes back to like what we said earlier. The larger the deals, the more risk there is. The larger the risk, but if you can actually close, it can pan out better. But the risk of closing is between you and your team, and is your team capable of closing a deal that big?
Right.
Has your team raised that much capital to be able to close a deal versus raising $2 million in a syndication?
I'm sure paperwork and bookkeeping and everything else is a nightmare on some of these larger properties.
Yeah. Generally, if you are raising 17 million, you're looking at more investors than a $2 million deal.
definitely.
unless you
Or
have a whole bunch
bigger
of people,
investors too.
unless you have a bunch of people coming in at like
A million
twenty
each.
five 2,500 or something. That's generally why you have like a minimum of like 25 to 50K for a minimum investment. So under a million, definitely would not even consider syndicating. 2 to 4 million. Like I said, the bigger the better. I probably wouldn't try to syndicate a $2 million deal. And again, it all depends on your network, your partners, what their liquidity is, um, what their investment strategies are, and if if you're not capable, if you have like zero money to invest, and your partners have zero money to invest, and you join a platform that says you don't need to bring your own money, you just go get investors. One, that's not necessarily accurate. I wouldn't invest with anybody who didn't put money in, but it's like I think they're setting them up for failure when they do that. Personally, so and it's not all about unit count. Sometimes it's about unit count. Sometimes it's about actual dollar amount. Like again, it takes the same number of staff for a 60 unit as it does for 120, 150 units. So
Well, another reason why it's not about unit count is because in the Boston area, 20 unit could be $4 million. And in certain other parts of the country, um, 100 unit could be $5 million.
so for syndication or JV or whatever, it's more about money, how much it costs versus like the economies of scale you're looking at per unit.
Well, officially, it's about how much, how active each person is in the deal. If you have people that don't want to be active, you almost have to syndicate it because every single person in a JV has to be an active partner, take an active role.
Yeah. And have we done an episode on that?
I don't know.
Because I mean, you can sign on a loan. Signing on a loan is considered being active, whether they don't, if they want to asset manage or not. So if you have four people who want a JV and four people all sign on the loan, all four people don't have to be involved in the day to day.
Well, yeah, the signing on the loan, yeah, but it gets to the point where you can't have everybody sign on the loan.
Yeah. Yeah. When you have a JV of 12 people, banks actually look down on that. They prefer to have people with 20% more um, equity in the property. So, for someone first starting out, what would you say would be an ideal unit count slash price for them to invest?
I mean, if they have no experience at all. I've seen both ways. I've seen some people say start small, then if you make mistakes, then it won't be as painful. I've seen other people say start big, find partners that really are experienced, find a good deal, and you'll be able to pull it off. I've seen people successful both ways.
Okay. So, really, what you're saying is just make sure you have the network to handle it and the business plan to carry it out, and you should be golden whichever route you go.
Yeah, I would say there's a lot of there are right ways to do real estate. There's a lot of right ways to do real estate. There's a few wrong ways to do real estate. Try to pick a path that works for you. So I mean, if you don't have a lot of time, then it's hard for you to be self-managing or doing something like that. If you have the time and you can have a third party person, you know, just like, is it better to self-manage or is it better to have third party management?
Yeah.
You know, you can do it either way.
Yeah.
I don't want to spend that much time in my life. I don't want to be at the properties every day, so it's not going to happen. I walk by one of my properties a couple times a week.
I prefer not to be involved in the day to day. One thing I've learned from what my little experience is with the day to day is that it's like super drama. Everybody has a story to tell, and everybody wants to tell that story to anybody who'll listen. Try to get a sympathetic ear, and quite frankly, I don't want to deal with it. But that's just me. Some people like that. Some people thrive on that. Some people eat that stuff up, and more power to them. I'm not like that. But if you want to learn more, you can look me up at ironcladunderwriting.com. I'm on LinkedIn, Facebook, Instagram, YouTube. Um, Frank, you're on all of the above as well, I
Not
believe.
as much YouTube except with you, but also TikTok, stuff like that.
Okay. You can turn your TikToks into YouTubes, you know. And also, I wanted to mention I do have a 3 evening underwriting intensive where we will go through underwriting a deal. We will go through how to find the good information to put into the model. We'll walk you through using the Ironclad model, the web app that I've created. And if you're interested in that, you can go to ironcladunderwriting.com/intensive and you can sign up. It's going to be August 25th, 26th, and 27th. So it's depending on when this airs, this should air before. So if you're interested in it, go to that website and sign up, and we'll see you then. And that's a wrap for this episode of the Ironclad Underwriting Podcast. If you got value from today's conversation, make sure to subscribe, rate, and share the show. And don't forget to connect with us on LinkedIn, YouTube, Facebook, Instagram, or check us out at our website at ironcladunderwriting.com for more insights and updates. If you have a question, a deal you're analyzing, or a topic you want us to tackle, shoot us a message. We'd love to hear from you. Until next time, keep your assumptions grounded, your models sharp, and your underwriting ironclad.